Welcome to Tech Talks, the first word in insurance, a podcast by Hyper Exponential. Welcome to Tech Talks. I'm Tom Chamberlain, otherwise known as Tech. That's pretty much all you need to know about me. In this episode, we'll be discussing pricing transformation, and I'm delighted to be joined by a veteran of the insurance industry, James Anderson. Hi, James.
Hi, Tom. Not sure about veteran.
Well, I was going to do a little bit more of an intro for you. So, James has worked at some of the largest insurance and reinsurance companies in the world, Brit, Allianz, Swiss Re, and currently a partner at EY. So I think that pretty much counts as a veteran. And just as a side note, also a pretty decent poker player, from my understanding.
Very kind, very kind. Tom's won a lot of money off me.
only a little bit. So James, yes, thanks for joining. Looking forward to the chat. Pricing transformation. So before we kind of get into the sort of the whats and the whys, perhaps we can just take a little time just to define what it means. A few different people will see things slightly differently. So how would you describe, how do you see pricing transformation?
Yeah, that's a good description already, right? That a lot of people see it in different ways. I don't think there's a definition of pricing transformation. But I guess for me, right, it's something you can't just do as your business as usual, incremental improvement. It's about having a vision of where you want to go to and then kind of a step change towards that vision. So it can be in a lot of different things, right? It could be your modeling capability, your deployment capability, how you engage with your underwriters, how you steer your portfolio. It could be lots of different things all under the banner of pricing, and you probably don't want to do all of them all at once, but it is this concept of let's take a big step in the direction of the future of your kind of future vision.
And I mean, you kind of mentioned a few words in there which sort of resonate with me. It does seem to be wider than just pricing, right? So this is not just an actuarial exercise. I think this very much encompasses, particularly in the specialty market, which I think we're kind of focusing on here, very much the underwriting side as well. And I think pricing and underwriting transformation sort of go hand in hand. I guess you'd agree with that.
Yeah, completely. I think it's one of those things. If you do a pricing transformation purely focused on what the pricing actuaries need, that's probably going to fail to some degree, in that huge amount of the benefit you're going to get from any pricing transformation should be how do you underwrite the risks better, how do you make better decisions, how do you improve your loss ratio.
Absolutely, and I think we'll kind of get onto that, which is the sort of the why of the change and the big benefits that you can get out of it. I think there's also a part, and you might have just briefly mentioned it as well. It's also just not sort of pushing in technology and sort of hoping for the best. There's more nuance than that, and we can get onto the sort of the more cultural shift and that side of things. But I think you also say it's about setting the vision, right? It's about understanding where you're going.
Yeah, and that's, I mean, you mentioned I work at EY, and I joined there 9 months ago, and that's actually been one of the really interesting things for me is seeing how all the different pricing teams and all the different companies work and how varied it is. And, that vision of pricing differs a lot. And I think sometimes is a sort of legacy of who set that team up originally, or, what the personal preferences of one or two people are. So really taking that step back and saying, how will pricing add the most value to the company? How does pricing fit into the kind of philosophy of the company? Is it a very traditional underwriting face-to-face relationship sort of company? Is it a data-driven, technology-driven company? Because that's going to have quite different needs from a pricing function, and you really need to be clear on your vision before you start doing things like technology and get kind of actually starting to execute, because I think otherwise you run the real risk of being disappointed by the end result.
Yeah, absolutely. Projects like that are doomed to fail. I think that's sort of any transformation type of project, being in pricing or across insurance, it's absolutely critical to know where you're going and why you're doing that, as opposed to just diving headlong into new technology. Let's go and implement that. It's quite interesting. So that you talk about the sort of legacy side and what's been happening. I mean, we analysed the about 13 of the top insurance and reinsurance companies, and over the last 5 years, and sort of pulled out from reports and stuff around what were their main priorities as a business. And very much we've seen a shift over the last 5 years. Previously, claims transformation and other areas, operations as well, have been very much at the top priority list. But actually, more recently, over the last 5 years, pricing has sort of come more to the forefront. So, what's been really happening over the market in the last sort of 10 years, and what's changing now that the pricing is really coming to the forefront?
Yeah, and first to just say that totally resonates to me as well in terms of both my previous experience of being a pricing actuary in industry and the change over the last 10 years. But to answer your question, I mean, a lot of the kind of pain points and reasons why you might want to change have been true for all of those 10 years. That your models, a lot of the pricing models are sitting in Excel, which has a lot of great features, but also brings a lot of challenges if you're trying to be have a systematic pricing process. There's not enough data capture. You are asking your underwriters and your actuaries to do a lot of manual, not particularly value-added work. It often leads to a lack of underwriter buy-in. You're not doing that steering side of things, and you're not capturing the data to then be able to build better models in the future. And you can end up in this sort of sad state of a company invests a lot of money in pricing actuaries and pricing tools and the underwriters' time on it, but actually the underwriters don't buy into it. The pricing tools are filled in after the risk's written with not much care. Whatever data's captured isn't of high quality because no one's putting much effort into it. And you kind of see, where's the value being added? So there's definitely been a need to change. Sorry, I'm not saying that's what every company at all. I think that's kind of a worst case catastrophizing, but there's been these drivers of change for a long time. So to come to your question of, I guess, why now and why over the last few years, and there are a few, this is personal opinion, but there are a few things that I see driving it. One is kind of the market cycle in terms of, a lot of companies lost a lot of money in the specialty market over the last few years, and I think have recognized that a lack of pricing framework, like a lack of underwriting steering, has hampered them, and is one of the things that they're now trying to invest in while the market's hard, while they've got kind of a good combined ratio, so that they're in a much stronger position once the market does start to soften. And I think that's definitely, EY does quite a lot of sort of analysis on specialty results, and from that tries to kind of tease out drivers of performance. And the two that always seem to come out is, one is just simply good underwriting at a line of business level, and the second is strong management of the cycle in terms of not growing aggressively when the market's soft and then growing aggressively when it's hard, rather than remediating. And all of those things just talk to pricing. You need to do strong individual underwriting. You need to have good tools and diagnostics and support to the underwriter. To manage your cycle, you need a strong underwriting framework. And so that's one key driver for me. Sorry, I'm going to keep on talking forever.
No, you carry on. It's fascinating, please.
Cool. So I think another one for me is sort of around, in general, an increased recognition of the importance of data. That there was maybe a bit of a boom in kind of AI and ML and people investing heavily in sort of data science teams a few years ago, which I think hit a bit of a block, or hit a road bump, in that they realized that they'd brought in all these smart people, strong academic backgrounds, but they didn't have any good data for them to work on, and they hadn't necessarily hired people who were good at data. And I think there's been a reset from that, and a recognition that actually a huge USP and a huge piece of the IP of an insurance company is their internal data, and therefore capturing it effectively, structuring it, thinking through the whole end-to-end flow, and from that being able to do things like build better pricing models, build better steering frameworks, has become really important. And therefore moving on to a systematic way of capturing your data throughout the pricing process is, I think, another driver of that change. I guess I'd say the last one I'll just call out is, in general, it feels like there's a transformation happening right in the insurance market, or about to happen, in terms of digitalization. That this sort of insane situation where a broker's got all the data on their database, they print it out, maybe to if you're lucky to something machine readable, email it to the insurer, who then pays someone else to key it back into their systems. I mean, I remember 15, 20 years ago doing individual account pricing where I'd got a scanned version of a print off of an Excel spreadsheet. And I was like, somewhere there is a spreadsheet that they could have just given me, but I'm going to type it in.
Yeah.
So I think the move from that to actually that's insane. There's going to be, much more of a move to sort of algorithmic underwriting, even if the underwriter's still there, but that the data will flow automatically. You need to have underwriting workflow. You need to have pricing tools that are digital to all link together. And then you need to have much more confidence in your models and an understanding of your models to be able to decide where you're going to do things algorithmically, where are you going to refer up to an underwriter. And all of these things they're not just pricing topics, but pricing is a sort of enabler and building block of them.
Yeah, I agree with all of those. Actually, I'll just also quickly make some points. Actually, going backwards across them. So, your point around things still being a very manual process. It's probably even worse than that, right? COVID was supposed to have sorted out all of this sort of paper trails and everything had moved online, but brokers are still wandering about the market with slipcases with things on bits of paper. So the fact that you get sometimes an email with a PDF can actually be quite good.
No,
and we're still in that industry where that happens. But you're right. Why on earth should there be PDFs of Excel documents when that could just be sort of sent across? It wasn't that long ago that I was watching part of the underwriting process, and someone had copied down some information from a screen onto a bit of paper and then walked it over to operations, who then keyed it into another system. And it's not so many years ago, and it's quite frightening that we've been talking about automation, right, which is a part of the sort of pricing transformation. And I mean, you and I have been talking about this since we started our careers, and we're still talking about it now. So it's fascinating that we all know we needed this transformation, and yet it hadn't happened. And you're right. I think with the data side as well, it's more critical than ever that this happens. We've the insurance industry has been using data for, like Lloyd's has been using it for hundreds of years, right? So stories of shipping, that they relied on sort of face-to-face tales of what was happening to give them the data. Obviously, we have a lot more and a lot better data than that. And I think this explosion of data, the 100 or so zettabytes of data that's consumed every year now, that's trillion gigabytes, so pretty high number. We have vast amounts of data, and it is no longer feasible just to be capturing these sort of bits and forms and sending them in. You need to have better ways of ingesting it all. And again, this is all part of that pricing transformation. So I can definitely see why now is more of a time. But the interesting thing, the first point around the sort of state of the market as well, we are for the first time in a long time in a very hard market. And at this point, actually, companies are making some money and doing quite well. Take away some hurricanes and COVID and Ukraine Russia wars and stuff, but the market is as good as it has been. And yet you'd have thought, sort of, as the market was softer in the past, that was the time when they really needed that technology. But I guess, I mean, this is probably the reason now why it is potentially changing, is that there is investment to be had. Interest rates are in a much higher state than they were, which means companies do have a bit more money to invest and spend on this sort of technology. So perhaps that is also a bit of the reason. And doing this transformation now before the market sort of turns again, when you're really going to need that extra margin, is kind of critical. So I'd agree with all of that, I think.
Yeah, and I say it's that old cliche, isn't it? The best time to have done this is 20 years ago. The second best time is now. And that's not to say, I think there are definitely companies who did do it 20 years ago, and you can see, you do tend to be able to see that in, that they had a much clearer strategy around the cycle, and they managed to outperform. So I think it's also been proven that sort of data-driven approach does provide value and drive performance.
Absolutely.
One other point I was just going to make is so my background is kind of Lloyd's of London, so I would be quite sad to see all the brokers with their big slip cases disappearing completely. But and well, to put it, sorry, a more sensible comment is, I do think relationships are a very important part and will continue to be a very important part of the industry. It's just that you don't necessarily need to have it all on paper, all of the data on paper to do that.
100%. The data could have been streamed directly from a broker into the pricing platforms and sort of been semi-underwritten by the time that the broker has arrived on foot to then chat about the risk and actually understand the more subjective parts of it. And again, that trading relationship, I couldn't agree more. It's interesting. And to your point as well, there's some companies I found a lot of companies have done this sort of transformation, some 10 years ago, some 20 years ago. That's now repeating. This isn't you transform and you're done. This is very much a journey, and I forget the number. It's maybe 7 to 10 years is the usual part. I think if you wait 10 years, you've probably left it a little bit too long. But every 7 or so years, a big pricing transformation should be happening because technology has moved on, data has moved on, the world has moved on, and you need to be at that cutting edge if you are to remain competitive. So all of those companies that have done well, we're seeing them repeat that exercise now again at that right opportunity. Yet.
And sort of as I said, sorry to interrupt.
No, go.
I was going to say, as I sort of said at the start, that there's lots of different types of pricing transformation. So even though you did a pricing transformation 2 years ago, say on your technology, maybe now's the time you collected some better data.
Right.
Let's start transforming the modeling. So it's also a cycle of the different bits of pricing feeding each other.
Yeah, absolutely. But then it's not even that easy though, right? We talk about it and say we should be doing it. And I guess if it was super easy, the market would just do their transformation and be getting on with it. But that's obviously not the case. So, and there's probably quite a few of these, but what do you see as the sort of main barriers for change and for this level of transformation?
Yeah, absolutely. And that, actually, again, sorry, it was an interesting thing for me about moving from industry to consulting is that rather than doing these transformations every 7 to 10 years, I'm actually getting to do them repeatedly. So I am seeing more both the barriers and the lessons learned, and that's really fun. And in terms of the barriers, I think there is an interesting thing around transformation, around pricing and underwriting that, you tend to see the big transformation spends, and a lot of it gets spent on things where you can clearly communicate the benefit in terms of financials, and it's often in terms of improvement to the expense ratio. And that's the fundamental of it's predictable and you can very easily demonstrate it. Whereas, actually you look at a combined ratio, by far the biggest part is the loss ratio. You look at the spread of companies' performance over the market, and the spread of the expense ratio is not huge, whereas the spread of the loss ratio is huge. And so you can really, by moving from bottom quartile to top quartile, it's enormous the amount of change you can make. But it's very hard to quantify. It's very hard to say next year, if I do this transformation, my loss ratio will be X, because you could say that, and you could then hope that there isn't a cat that year or something.
Yeah.
Yep. But I think that is a real challenge, and it's something we really, when we're doing this work with our clients, it's something we try and support them on a lot, because it is hard to quantify that, and finding ways to kind of communicate and explain the benefits that are coming, both quantitative and qualitatively, it is really important. And I genuinely believe this is where the most value for companies comes from, but it's harder to communicate that. So that would be my first barrier. I think there's a second barrier about any sort of big transformation, right? That they're hard and they take a long time, and maintaining that sort of the momentum and the enthusiasm and the resourcing throughout a kind of large scale transformation does take a lot of time, does take a lot of effort, and you really need to think through your strategy and that kind of change management piece of bringing people on the journey, because there's always an example of how this hasn't worked somewhere and people who've been burnt. So it's not something people want to jump. I think it's right that people don't jump into this lightly, that people think through exactly what they want to get out of it and plan how they're going to get there, because they are challenging projects to do.
Yeah, it's the vision you mentioned earlier, right? It's about
Yeah,
setting that at the start.
yeah, no, exactly. And I think there's also something about the way you lead people through that project, because there, a project that takes a year, 18 months, there's going to be a bit in the middle where it's hard. Not everything's gone to timelines, unless you go with us, obviously, then it will be smooth. Sorry, you can cut that if you
No,
like.
no, that's enough plug there. Carry on.
Yeah, thank you. But you know, there's always challenging moments. There's always that bit before you first deliveries where you um, there's a bit of momentum or a bit of enthusiasm lost, and having people who can drive that change, remind people of the vision is also so. Yes, the vision is really important, but then the leadership through that as well, and the change management is critical.
Yeah, it is difficult, and you've obviously seen it done well, and maybe done not so well as well. And it's an interesting point about the time it takes. This traditionally has been a long journey. We've been through these in house, and also for more the consultative side. But I think that is changing a little bit now. I don't think transformation needs to be taking 5 years anymore. We've had customers and clients who have done this in less than a year. And when I say done this, I mean full on transformation. This is implementing a new pricing platform, new underwriting processes, new front end, data out, all of this interconnected and completed in less than a year for a very large scale and legacy insurance companies as well. It's not just the new ones who can do it. So there is light at the end of that tunnel a little bit, to be able to do the change. It doesn't need to be this long thing anymore, I don't think.
No, exactly, and it's also how you structure it, right? Part of that not having a slump in the middle is to ensure that you're kind of accelerating the delivery of wins and value added to the start, so that you are proving value and keeping that momentum.
Yeah.
Um,
I really liked how you framed earlier as well about the key levers on this with the combined ratio, and obviously with the expense ratio, the fact that there isn't that much margin. It is a proportion, and you could, if you chop a couple of points off it, it's just as impactful as chopping a couple of points off the loss ratio. But as you said, the difference between what the top quartile and the bottom quartile companies are is not huge, and the loss ratio one is massive, and that is a clear indicator that you can make these huge differences. And I think it's to your point about it is very hard to prove. I would love to be able to go and say exactly what the loss ratio benefit of pricing transformation is, as I'm sure you would, because then the sort of the cost talks go away completely, and it's really obvious why you do it. But there's a lot around. You can see these tangible benefits, and you mentioned the sort of quantifiable things. So if you are saving your underwriters tons of time, if you are saving your actuaries tons of time and allowing them to focus on actuarial work, to focus on underwriting, then you kind of like that sort of time saving benefit is then that will drive that. There's plenty of reports out there. I think a McKinsey report recently said it was between 3 and 6% impact on the loss ratio, or percentage points, so of pricing transformation. And we also did a survey at Gyro last year for, it was over 150 actuaries, and over 2/3 believe that, again, pricing transformation will have at least a 2%, if not more, impact on the loss ratio. So we know the case for change is there. Sometimes boards are much harder to convince on that, because, as you said, with an expense ratio led one, you very much see it's like, well, I can make FTE savings here. There's a clear impact on the loss ratio, and then you can see the cost benefit analysis. So it is a little bit difficult, but companies are going through it and doing it successfully. So whilst there are these barriers, I think it's a very positive outlook, and
Definitely.
with the right help, from a consultant point of view, and the right technology, this is how you do it. And I think both of these things are available in the market now, and companies should take sort of full advantage of them.
Yeah, and actually, to a kind of earlier question you asked me of like why there's change now, I think another of the reasons is that a lot of the solutions that are available to companies that are available now weren't available 5-10 years ago. You had to do it yourself in the London market, particularly, and doing it yourself brings a lot of challenge. I think we've both been at companies that has, sometimes successful, sometimes not, and you know. having better solutions and better options out there for different types of company is probably another driver. One other thing on the kind of benefit qualification, and something else that we do ourselves, is that kind of on the quantification, because we've got quite good benchmark data, we can also do some of that sort of stuff of, here's how you sit amongst your peers. If this transformation could get you to being just median among your peers, this is the loss ratio. There is some ways you can do different ways you can quantify it with some assumptions underneath it. And then I also agree there's a few sort of market-wide analyses by kind of the strategy houses, giving some sort of high level.
More anecdotal, yeah.
Yeah, well, I'd love to know where they got it from. I'm sure there is some analysis.
I think they surveyed a load of companies and they indicated that yes, they believe it could be between. It is a difficult thing to measure. As you said, you could have a cat event and all of a sudden the loss ratio for that line of business is completely destroyed, or you could not have a cat event and actually the loss ratio improves.
Yeah,
regardless of what you're doing. But the underlying trend should always be that this is there. But I think we are getting better at quantifying and seeing that, and I think companies do see that benefit, whether however tangible or not it may be. And I think we are much better now at articulating what that is. And I mean, you mentioned something sort of more kind of looking forward, sort of beyond the sort of pricing transformation, and you mentioned sort of algorithmic underwriting, and I just wanted to quickly sort of talk about how companies are sort of innovating going forward on top of then the transformation. So what does it look like in that area? And actually maybe just to go into what actually algorithmic underwriting is.
Okay, yeah. So, I mean, it's kind of quite a fancy title for something that has been around a lot in different places, but, it's fundamentally the idea that your underwriting is your kind of flow. It's a flow rather than a piece of paper to piece of paper. The data is ingested automatically, and some of the underwriting involvement is reduced in that there's one extreme where every single risk is priced by an algorithm and there's no underwriter involvement. There's another one where some of the base level ones are priced by the algorithm, and then kind of referrals are kicked up to the underwriters as they wanted. And you've seen this in the kind of SME and retail, that it used to be almost everything was referred, and over 20 years it's moved to be almost nothing is referred. And the London market is a lot earlier in that journey, but you are seeing people try and build that out more and more in different ways. I think the big poster boy example is the Brit's Key Syndicate, which is with its automatic follow, which is doing one type of algorithmic underwriting. It's follow only. There's still always somewhere a human being doing the lead underwriting, but that choice of follow and the choice of follow line is purely algorithmic. You're then also seeing, I think, lots of other examples of companies who are doing it for their, doing lead follow business for smaller kind of types of business, general aviation, PI, that sort of example, where it's kind of a broker a links direct to the broker feeds the data in, and then it's automatically priced and a quote issued. So that's starting to build up, but sort of touching to the point we said at the beginning, that it feels that that's going to come more and more, and it's going to become the default more and more, that you need to have those capabilities. And so to me, it feels like there's two paths emerging, that there's going to be this more and more the simpler business, the business that you're following will become automated, will become algorithmic, and then the more complex stuff is still going to be underwritten by experts. And there, but there's still a transformation there of giving a lot more. Well, I don't think I coined this, but this kind of concept of kind of augmented underwriting, so that not that the underwriters become a Borg or something, but that that the underwriter is giving a lot, isn't just given here's your risk, here's your technical price, but actually is given a huge amount more insight into the risk. Does a lot of the data flows are still automated, and there's probably still quite a lot of algorithms behind that, giving him better insight, giving him or her better insight, pulling in external data sources automatically. So there's a sort of transformation on the underwriting side, that either is to feed an algorithm that automatically prices the risk, or to feed an underwriter with a lot more insight to make a better decision making. So I think it's both is kind of the structure behind both is actually going to be quite similar in some ways. It's just whether it's an algorithm or an augmented underwriter.
Yeah, and all of this is basically enabled by that data flow, right? But both of those require that streamlined data. So either the algorithm or the human can actually again do their insightful parts and analyze the risk as opposed to spending half of it rekeying of the data.
Yeah, data is like absolutely critical, and I think all of this is based on the assumption that we as an industry get a lot better at data, using our data and having consistent data standards and consistent data transfer.
Yeah, absolutely. And I guess it wouldn't be topical unless we sort of talked a little bit about AI and generative AI. And I came across a phrase the other day, and I think this particularly applies to insurance, that I don't think underwriters or actuaries are going to be replaced by either of these things, but you may well be replaced by someone who knows how to use them very well. I was intrigued because we have seen AI in the market a bit in the specialty space, particularly on some of the lines you mentioned, like PI, general aviation, where you have a high volume of low premium quotes, and you need to do bits of risk triaging. So there's been some machine learning models applied to these already. But with the sort of emergence of the generative AI, so the chat GPTs, do you see anything here infiltrating into the insurance space, or is this very much a I to be fair, I almost thought I'd write out my intro on ChatGPT, and then I was like, no, I'm just going to do it myself. But there's lots of interesting use cases. Is my point. I'm curious to what your thoughts are, whether they apply well in the insurance space or indeed anywhere else.
Yeah, and kind of on the non-generative first, I guess. I don't know how much of the kind of algorithmic underwriting is true kind of ML AI now. I think a lot of it is going to be quite. I'd love to know what Brit's Key is doing. I'm sure they have a lot of AI capabilities in house, and I'm sure they are doing a lot there. A lot of the algorithmic underwriting I see though is quite simple rule based at the moment, which is fine because that's all it needs to be. I'm sure that will develop over time. I also think a lot of that kind of ML and kind of natural language processing also applies to the sort of the data flows of linking data, identifying gaps in the data, pulling in data sources and matching them all together. So I think there's a lot of not necessarily the pricing, but the kind of flow of data and the bits around the pricing that can be immediately helped with these models. On the kind of chat GPT, I'm a little bit worried that by the time this podcast gets released, everything I say will have been invalidated, and I will be.
It's moving quite quickly, I think.
Yeah, exactly. Yeah. But I mean, I'm sure and I liked your comment of not be replaced by AI, but being replaced by someone who knows how to use the AI, because clearly using something like ChatGPT is a skill. And being able, my only use of it so far is I got it to write a bedtime story for my daughter. Where, it was really good. So I told it to make the main character her name. I made it themed around rabbits because she likes rabbits, and it asked it to have an underlying theme of sharing being important, and it knocked me together a 5-minute story. Really good, but that's
awesome.
Not particularly insurance.
Yeah. No, but that's
not particularly insurance related.
What a great use case.
Yeah.
So you are now the master of bedtime stories.
Exactly. I just go. Let me think of a story off the top of my head.
Awesome.
But actually doing that made me realize, it took me a few attempts to work out how to, even something quite simple, how to type that in and how to ask the right questions. And to your point of knowing how to use it, I'm sure it will come. And I'm sure, there's some just super obvious use cases around, you've got a slip, helping the underwriter understand that slip, some of these solutions are already in the market, just not using these technology. And I'm sure it will supercharge that of really helping identify the understanding of the kind of contract wording. Has anything changed since the last time you looked at it? All that sort of stuff. A lot more automated checking of that sort of data inputs and contract. If you wanted to check if every one of your contracts has a silent cyber clause, suddenly you've probably got But I mean, that's not necessarily a pricing one, but it's a fun one
for insurance in general.
Yeah,
and I guess
exactly.
it does sort of fit into the price and underwriting space, right? If you want to understand slips and understand your risk profiles, then that's kind of all part of it. No one's getting all of that information out of slips at the moment, and I do remember having to trawl through lots of ones to find sublimits of various bits and pieces, and that could easily be done through there. So yeah, it's an interesting topic. We shall see. I think it will evolve over the coming months. There's still huge data privacy issues around ChatGPT, and people need to be incredibly careful about what they put in there, particularly around company IP, company data. It's open on the internet, so yeah, you need to treat it with the same respect as you do when you're googling for information or transferring data. But we shall see where it lands coming towards the end of the year.
I was going to say, because I do see that there is an opportunity to have almost like an underwriter assistant, right? That the underwriter could sit there and, it's pricing a risk, and you could ask it questions, and it would, how many mines like this mine have blown up in the world, and it could give you answers, and it could give you sources, and as you said, it could help you interrogate the slip and think about the risk you're writing. But as you say, it's got to be worked out, and you've got to be not uploading your documents onto to be available to everyone as you do that. So I'm sure it will come in some form or other, and it seems very powerful as a kind of strong way of kind of processing and understanding text. We'll be watching it with interest. What comes of it?
Yeah, me too. James, this has been absolutely brilliant. I have one last question, which I'm sort of asking to everyone, and I think given our topic, this is probably a sort of easy answer, really. But what do you think insurers, reinsurers, MGAs sort of need to be doing now to prepare for what will inevitably be the softening market to come?
Yeah, and I mean, it's everything we've been talking about, but for me, it's particularly building that framework of, that kind of pricing and underwriting framework of, you're seeing that rates are starting to slip. You've first of all, you've got the MI to understand that, but then you've got the mechanism to be able to enable your kind of senior underwriters, your portfolio underwriters, a way to steer their portfolio and to both kind of set out a strategy for how they want their teams to be renewing their books, and then to be able to monitor it in real time and react. I think that's going to be super critical when you're kind of moving into this soft market, because it is such a it's going to be moving into such uncertain times with so many changes at once.
Great. Yeah, good advice.
Cool.
So yeah, brilliant. Thank you very much, James, for joining and for discussing an incredibly interesting topic. And I'm definitely going to be stealing your idea of ChatGPT for bedtime stories. Much appreciated. So thank you for joining.
Yeah, no, thanks, Tom. Great to be here.
That concludes another episode of Tech Talks. If you enjoyed today's show and want to find out more about the topics discussed, head over to hyperexponential.com to gain access to a range of resources related to this episode. The link is in the description, and of course, wherever you're listening to this podcast, make sure you like, subscribe, and leave us a comment or review. Thanks so much for joining us, and see you next time. Bye.